Hello and welcome to Stockwatch, presented by me, Evan Lucas, for Go Market Securities. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which is relied upon as any form of personal advice. Go Market Securities does not know your personal scenario, nor your personal financial goals, and therefore none of which is relied upon as any full advice at all. It is just general in nature only. Staples. They have been front and centre for all the interesting reasons, and I use that word deliberately because they have been the absolute forefront of inflation. Inflation in fresh food particularly has been something that everybody has felt, not just us in markets and in equities investing. It's been across the board. And having a look at the second quarter of FY23, food inflation was at 9.2% across the industry, and fresh food over dry was significantly better. What I also want to highlight there is if you have a look at that, it's up from 8.2% in the first quarter of the FY23 year. Next thing to really look at is Woolies and Coles. Woolies at the moment is actually outpacing Coles on their inflation figures. Woolies showed you that there was a 9.3% increase in the second quarter of the financial year, and that in itself was what drove it higher. Coles 9.1. If you look across the fresh to dry split too, Woolies continues to beat that. Fresh food at Woolworths was up 10.3% versus 8.8% for their dry. Coles was the other way around. It was 8.8% for their fresh food and 9.2% for their dry. Overall, you're seeing a slowdown though in the split across it, which is a good thing to see, and you should be seeing that. We should be seeing food prices come down because the pressure in supply chains is moderating, although not as much as we were hoping. Inflation also will continue to be a massive trend in that food. That needs to be pointed out as well. You need to understand that the food inflation story is not going away anytime soon. That therefore brings to the actual individual movements that Woolies and Coles can give you, promotions, and how their promotion breadth and depth is changing. So far, you have seen that Coles is trying to recapture share like it did in the early 2010s. It's when it was the most and best performing like-for-like sales provider, which it's lost to Woolworths over the last 5 years. It means they've kept their overall discounting and promotions longer and harder. They've now actually expanded out to 350 items in their what they call their lockdown pricing scenario, all the way out to March. Woolies, on the other hand, is letting a lot of it go. They are actually allowing food inflation to expand. They are diverging away from that environment and are being more specific about what they offer, down to around about 120 products on discount. And that's going to actually go even further once the 31st of January comes. It's going to drop to around about 80. It's an interesting time to be doing that, considering that food inflation and cost of living is a massive problem. And watch that space. Woolies might get better margins, but do they actually see like-for-like sales fall? That is what I'll be watching for very clearly when they report at the very back end of February. Keep an eye on it.